welcome back to the ApexBAI Insider. Today we're looking at a problem most founders don't realize they have. So building businesses that look successful but aren't actually sellable. So I'm joined here by Brian Franco, founder of Meritage Partners, who's spent years advising on what actually drives enterprise value and, more importantly, what quietly destroys it. So Brian, good to have you on.
Thank you, Christos. Pleasure to be here and with your audience. Looking forward to this conversation together.
Great. So you've said that most businesses aren't actually sellable, and from what we're seeing, client acquisition is usually where that breaks down. So I just wanted to focus there. Now, if a firm is doing $2 to $3 million, but the founder still owns all client relationships, how does that get viewed in a deal?
When you think about an acquisition or a sale, you have to understand that the buyer universe is typically made up of investors. Those investors are a combination of debt investors as well as equity investors. And so the way they're underwriting these transactions is to risk. And so when you consider, risk in a business, such as it could be key person issues, it could be high revenue concentration with a particular customer or a client. And so when these are analyzed in the underwriting process, it creates risk that has to be offset. And risk is typically offset by deal structure or terms. So, from a selling standpoint, you want to receive as much cash, if not all cash, at close. Now, not all transactions go that way for a variety of reasons. Some, yes, there also sellers are working with buyers and investors to offset or balance that risk out. But sometimes, sellers also understand the upside potential if they were to provide some level of terms in a transaction. So, but in the context and the focus that you're bringing here is risk lives inside those types of elements and specifically, key person issues.
Of course, we see, a lot in firms, they think they're scaling, but all the deal flow still, sits with the founder. So nothing really changes from a sort of valuation standpoint. And where do you see client acquisition creating the biggest valuation risk in founder-led businesses?
So you see, it's different for different companies, right? Risk can live in different forms. We talked about key person risk. We talked about customer or client concentration risk. But there also may be other risks associated with the business. So the biggest issue that we typically see in companies, let's say under $20 million of revenue, is going to be that key person risk. They're still involved in the day-to-day. Major decisions are made by them and only them. And, although they may have an org chart of second tier of leadership, they're still making those decisions, right?
Yeah.
And so what has to be addressed at the point of an M&A transaction or a third-party investor coming in to acquire the business is they need to understand how to offset that risk. And we talked about how they do that. But that's the biggest risk that we see is ultimately key person risk. The business owner is too involved in the day-to-day to step away, even for their own vacation. Forget about selling the company. It's difficult for them to break away, period.
I can imagine if someone's buying a business and they they realize that they can never go on a vacation if they buy the business, it's not very attractive, is it?
No, exactly.
Buying a very expensive job. And
Precisely.
And what actually needs to change for that to become transferable in your world? How do they go about changing that?
So to cause change there, you need to implement systems, documented systems. So document your processes. Make sure that your team knows what to do, when to do, and how to do it. And it sounds easy, but you'd be surprised. I mean, there's a lot that goes into developing the right SOPs, and then not only developing them, but teaching them to the team and keeping the team accountable to those SOPs. And that's really where people get stuck in the mud is the implementation, because if you're going from a time and a place where you did not have documented SOPs, and let's agree that everyone has a system, it's just that not all systems are documented. And so going through that exercise, you're going to force those that have been with you at a time when you didn't have these processes documented to now a time where they are documented and people are being held accountable. So the risk there for a business owner is, well, what if the team doesn't like the new system? What if they don't like the accountability? Will I lose people? Will I hire better people or attract better people? And the answer is a bit of both, right? You're going to lose those that are not going to adapt to the accountability that you're ultimately driving and installing in the business. But there again, you will attract much better talent because better talent is more mindful of those systems and those processes. They want to be part of an organization that has built out a machine that they
Yeah.
could come and plug into in whether it's a service business or manufacturing, whatever it may be, they could plug in their expertise into that organization. And so there you have it. It's going to be a mix of both.
Yeah.
You will lose some people, but arguably you should have already lost those people. You just didn't have a good reason to.
Of course. Of course.
Or you had more reasons why you should keep them, knowing that they weren't a long-term fit. But then also you give yourself that opportunity to attract the right talent that appreciates what you're building in terms of systems and processes.
Okay. So I suppose short-term loss, long-term gain in a way. You might lose some people that were talented. Long term, you need someone who can follow the system and keep things moving forward, right?
Precisely.
When you speak to a business owner, so if they have this key man problem and they're trying to implement these new systems, do you help them implement them, or is that kind of something where business owners only come to you when these are implemented and it's ready to sell?
So in the beginning, when we started testing and launching this about 10 years ago, we would parachute in third parties to do this work. And it was a do it with you type of model. What we discovered over that time is it when it worked, it worked. When it didn't work, it was really difficult to to keep people accountable to a journey, if you would, that we laid out, a roadmap when there were other centers of influence in there. And so what that helped us understand and what we provide now is, yes, we provide this work, this advisory work, and we do it inside a curated community called the Empire Builder Community, where business owners could come in and learn. We have virtual training courses that they could access and help them understand how the private capital markets interact with business owners and specifically business transactions. And so we're helping them to understand and really have this ultimate paradigm shift in how they see their own company. And but in this community, they have the support from our team and what's our team of experts, whether it's a fractional COO, fractional CFO, someone that's going to come in and quarterback this process with them to make sure they stay accountable to the timeline that we put out, which is ultimately the timeline is, I don't want to make it sound like we're dictating when this goes down, right? The timeline we build with the client. So we're helping the client achieve and meet their expectations. And when we do it right, we ultimately beat their expectations, which is a win for everybody.
It's just like anything. Implement these structures, and bit by bit, it kind of you reach the goal. So, what would you say founders think matter the most, but buyers actually don't care about when structuring an acquisition?
A case study we're currently working on where the founders grown the business dramatically over the last 3 years. And there were some influences that helped that growth, but they captured the growth. So they did what they were supposed to do. Investors look at the last 3 years and say, well, wait a minute, this last 12 months specifically is very attractive. The last 12 months, they have really outperformed prior years. And the question then becomes, how sustainable is that? Can they continue on that growth trajectory or not? And so there again, when you think of underwriting from a buyer and investor in the market, they're underwriting to risk. And so when you look at massive growth, as I'm describing to you, the risk is, what if that doesn't happen again, right? So what's the insurance or assurance that that revenue is going to continue at that level and at that growth? And so it's extremely valuable to the south side of the table because they've outperformed themselves historically. To a buyer and investor, they're questioning, can this be sustained? Because buyers and investors are underwriting to predictable revenue streams. This is why software companies are so valuable. You have a price per license or per seat, per month, month after month after month, year after year after year. That's predictable. You could forecast that. You could understand what your attrition is, how many people no longer renew their subscriptions, and it's formulaic.
Okay.
So when you consider that, you can project or you could predict revenues. So in a case where it's a project-based company producing revenues deriving from projects that they have achieved or won or successfully serviced, the question then becomes, how good is the business going to be at accessing and capturing similar projects over and over and over again for months and years to come? So this is one area where we see a seller sees much greater value than a buyer or an investor would in drastic growth in a company.
No, that makes sense. So essentially the sellers are, just focusing on growing the revenue, but not actually reducing the risk to make it more appealing to the buyers. Okay.
Correct.
And okay, and why do you think why do you think buyers struggle, founders struggle so much to fix this, even when they know it's a problem? Is it mainly just because of the people that they work with, their employees, or is it other things? They're just too set in their ways, or?
Well, you have to empathize with business owners, right? Because they are wearing multiple hats every single day, and they're working hard to eliminate one of those hats and hire the right person in the right seat, which means revenues have to be at a certain target so they could afford that talent. And this is a juggling act, right? Especially if you hire the wrong person. Or if you get the wrong person, maybe it's the right person, but in the wrong seat. And so when you think of a business owner that's running the day to day, it's not difficult to get distracted, right? And we see it all the time.
Thank you very much for that, Brian. If someone is listening to this and realizing their business might not actually be transferable, where should they go to understand how to fix that properly?
Yeah, thanks for asking. So a couple resources we will provide to the audience. So if they go to inevitableexit.com, they will have access to my book, The Inevitable Exit. But also we have a gift there where they could access the top 10 deal killers of an M&A transaction. And so they could find that again at inevitableexit.com. And if they choose to purchase a book, great. There's a lot of information there that we will further expand on the discussion we had today. And we'll invite them into a community if they are ready to get to work, because this work is not easy to do on your own. You need to have the right resource, the right coach and quarterback, if you would, to drive them through this process.
Great. So it's like a team of mentors in there as well, and yourself.
Precisely. Yeah, we do monthly group calls and quarterly one-on-one calls to make sure the client is on track and doing everything that is expected of them, and so that we can help them reach that intended destination.
Great, Brian, that was sharp. Especially the links between the sort of client acquisition, valuation risk as well. So, appreciate you coming on today. If there is one thing to take from this as well, it's growth without transferability doesn't create value. So This is the ApexBAI Insider, where we break down how advisory firms scale without increasing dependency. See you in the next one.